Welcome to Books in Sum, your go-to for bite-sized book summaries.
The Behavioral Investor by Daniel Crosby. We learn that our brains were originally developed to protect our ancient ancestors, and that they continue to exert an influence over us that we may not even be aware of until it is too late. Successful investors know that their brains are susceptible to subtle, subconscious influences from their surrounding environment. Understanding how your brain reacts to its environment and how it can influence you in ways you might not even realize until it's too late is crucial if you want to be a successful investor. The takeaway is that knowing how your brain functions is crucial to financial success. Even though you probably don't go to work facing mortal danger from saber-toothed tigers in the bush, your brain still acts as if you are because it was designed to keep our prehistoric ancestors safe. If you're evaluating a financial risk, for instance, your brain's defense mechanisms activate, making it more difficult to think clearly and more likely that you'll miss important information. Also, our brains push us toward hastiness. The most crucial information is that our brains are attracted to money regardless of its actual value, making it hard to resist the promise of reward. The fact that people invest more in the spring and summer and have lower returns on cloudy days is further evidence that our behavior is heavily influenced by our emotions. It's important to recognize that you're not as logical as you like to pretend to be because these patterns show that your actions are heavily influenced by your emotions. We humans are great at rationalizing our decisions and smearing the alternative we didn't go with, making it hard to change course if something goes wrong. Because of our need to protect our sense of self, we often find it difficult to abandon a course of action that hasn't been successful. The two most crucial points are that investors should get used to being uneasy, and that overconfidence is a liability. Overconfident people are more likely to engage in self-destructive, ego-driven behavior, such as being incorrectly optimistic by 11.5% about their annual returns. Furthermore, investors should diversify their portfolios because it is never a good idea to put all of one's eggs in one basket, even if the wealth of a company is growing. This is due to the fact that investors are easily duped into thinking they've found a sure winner, despite the fact that it's unwise to put all of their money in a single venture. The risk of a complete loss can be mitigated and market forecasts improved through diversification. Since people are prone to confirmation bias, it's smart to get stock performance forecasts from multiple sources that employ various methods. Successful investors learn to embrace the unknown. When the Mona Lisa disappeared from the Louvre in 1911, news reports sparked a media frenzy. Because it requires so much mental effort, this story illustrates how people tend to favor the known. Successful investors learn to accept the unknown. Theoretically, your portfolio's equity allocation should reflect the relative size of each country's market. The majority of British investors put most of their money into British companies, even though the UK's market value is only 10% of the global total. Investors are missing out on international opportunities and exposing their portfolios to risk by focusing solely on domestic markets. Behavioral investors prepare for the inevitable ups and downs in the market by spreading their investments across various sectors. To be a successful investor, you need to keep an open mind and not miss the obvious. Data analysis firm Morningstar found that it isn't a brilliant manager or a state-of-the-art process that predicts a fund's performance, which is surprising given how easy it is to become blind to simple solutions in high-risk situations. Investors also err when they look only at the stock's short-term performance. Key points include the need to look at the big picture, check for stocks that may be vulnerable to bankruptcy or fraud, diversify to reduce risk, and put faith in the passage of time. Investors need to be in control of their feelings because complex secondary emotions like nostalgia can arise when happy and sad memories are mixed together. One must take the long view, check for stocks that may be vulnerable to bankruptcy or fraud, diversify to avoid disaster, and put faith in time in order to achieve this. You need to have a long-term perspective. Check your stocks for potential bankruptcy or fraud, diversify to protect yourself from disaster, and put your faith in time if you want to achieve this. Last but not least, one must learn to meditate in order to slow down their thoughts. Since practicing mindfulness reduces activity in the brain regions responsible for greed, it can be a useful tool for investors. Successful investors recognize the importance of trusting their gut. When faced with a complex decision, conscious thought is less helpful than when faced with a simple one. In order for humans to make good decisions, there must be stability in the environment, an abundance of high-quality feedback, and a clear understanding of the consequences of our actions. Accepting that conscious thought is not the best decision-making tool, investors should instead rely on model-based approaches, such as extrapolation algorithms, to make up for the limitations of the human brain. There are a few key points to take away from this article, and they are that models are just as good as humans at making decisions, and that they are invaluable in times of high stress and low confidence in one's own judgment. You need to get over your apprehension of market bubbles if you want to be a successful investor. Like falling in love, when we become enamored with an idea like the dot-com boom, we tend to ignore the red flags. Bubbles are a natural part of capital markets, but they are not as common as you might think, so successful investors learn to control their fear of them. It's important to learn how to control your emotions because, despite the facts, many people are still afraid of bubble. If you don't take advantage of opportunity, you might find yourself stuck when you could be moving forward. When the market is volatile, the most important information in this text is the process for developing a rules-based system to increase caution. A 200-day moving average is used to create a momentum-based model in which assets are held when their price is higher than the average and sold when it falls below the average. Long stretches of doing nothing can improve your chances. Understanding the brain's response to stress at work and learning to make better investment decisions consciously are also crucial. Finally, using the RAIN model for stress management is crucial for regaining mental equilibrium.
We hope you found this summary helpful in your listening journey. If you're interested in diving deeper into the topic or getting your hands on the whole book, be sure to check the description below where we've included links to the book and other related products that may be useful to you. Don't forget to hit the subscribe button to stay updated on our latest book summaries. And feel free to leave a comment with any suggestions or requests for books you'd like us to cover. Thanks again for tuning in and happy listening.